If you don't understand bonds, you don't understand money. Mark is at a dinner party explaining his portfolio to a guy he just met named Trevor. Mark talks about his index funds. He mentions his Roth IRA like it's a personality trait. He name drops the S&P 500 with the casual confidence of a man who has clearly watched several finance videos on his lunch break. Trevor nods along, impressed, and then asks one simple question. So, what's your bond allocation looking like? Mark's confident expression does something complicated. It tries to hold its shape for about a second and a half. Then, it collapses into the specific kind of silence that happens when a man realizes he has been explaining investing to a stranger for 10 minutes without ever once thinking about half of what investing actually is. Bonds, Mark says, like he's trying out a word in a language he sort of recognizes. Yeah, I have some of those. Probably. He does not have some of those. He has no idea what's in his target date fund. He knows bonds are the boring slice of the pie chart, the part for old people, the part you ignore because stocks go up and bonds just sort of sit there being beige. Here's the problem with that. Bonds are not the boring part of finance. Bonds are the operating system underneath the entire financial world, and almost nobody who isn't a professional has ever been taught how they actually work. My name is Nick. By the end of this video, you are going to understand why your mortgage rate, your savings account, and the stock market's worst days are all speaking the same secret language, and that language is called bonds. Let's start with what a bond actually is, because the word itself makes people's eyes glaze over before they've even learned anything. A bond is a loan. That's it. That's the whole concept underneath all the jargon. When you buy a bond, you are lending money to someone, usually a government or a company, and they promise to pay you back later with interest along the way. Think of it like this. Your cousin asks to borrow $5,000. You say fine, but you want $200 a year in interest until he pays you back the full $5,000 in 10 years. Congratulations, you just issued a bond. Your cousin is the government. You are the bondholder. The $200 a year is called the coupon. The day he pays you back, the original $5,000 is called maturity. That's a bond. A company or government needs money now. You have money now. They agree to pay you a fixed amount over time in exchange for the loan. Boring? Maybe. But understanding this one relationship is the difference between people who understand how money actually moves and people who just own a slice of pie chart they've never looked at closely. Now, here's the part that breaks people's brains the first time they learn it, and it's the exact question that broke Mark at that dinner party, metaphorically. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. They move in opposite directions. And almost everyone's first instinct is to think that's backwards. Here's why. It actually makes perfect sense once you see it. Say you bought a bond last year that pays you 3% a year. That bond is now sitting in your account doing its job. But this year, interest rates rise and brand new bonds being issued are now paying 5% a year. Suddenly, your old 3% bond looks pretty unimpressive sitting next to the shiny new 5% bond. Nobody wants to buy your boring old bond at full price anymore when they could buy a new one paying more. So if you want to sell your old bond before it matures, you have to sell it at a discount. Your bond's price goes down, even though nothing about the bond itself changed. The only thing that changed was what else was available. The reverse happens when rates fall. Your old bond, still paying that fixed 3%, suddenly looks fantastic next to brand new bonds only paying 1%. Everyone wants your bond now. Its price goes up. This single relationship, prices and rates moving in opposite directions, is the most important concept in all of fixed income investing. And once you understand it, an enormous number of financial headlines that used to sound like nonsense suddenly make complete sense. Here's where this stops being trivia and starts being useful. Bonds are not some isolated corner of finance that only affects people who specifically buy bond funds. Bonds set the price of almost everything else that involves borrowing money, which is most things. Your mortgage rate is priced off the bond market, specifically something called the 10-year Treasury yield. When that yield goes up, mortgage rates go up within days. When it goes down, mortgage rates follow. The reason your neighbor got a 3% mortgage in 2021 and you're staring at 7% in 2026 isn't random, it's the bond market. Your savings account interest rate is connected to the same machinery. When the Federal Reserve raises rates, short-term bond yields rise, and banks eventually pass some of that along to savers, though usually slower and smaller than you'd like. When rates fall, that 4% high-yield savings account quietly turns into a 1% account over a matter of months. Even the stock market's mood is downstream of bonds. When bond yields rise significantly, investors start asking why they should take on stock market risk when a government bond will now pay them 5% with basically none of the volatility. Money rotates out of stocks and into bonds. That rotation is a huge part of why stocks sometimes sell off hard on days when the only real news is an interest rate announcement that has nothing to do with any specific company. Bonds are not the quiet corner, they're the thermostat for the entire room. Now let's talk about the moment a lot of people learned the hard way that bonds are not the same thing as safe. In 2022, the Federal Reserve raised interest rates aggressively and rapidly to fight inflation, taking rates from near zero to over 4% in less than a year. Remember the relationship we just covered: rates up, bond prices down, and because rates moved so far so fast, bond prices didn't just dip, they cratered. The Standard Total Bond Market Index Fund lost about 13% in 2022. That might not sound dramatic until you remember that bonds are the thing people hold specifically because they're not supposed to do that. Long-term treasury bonds, the ones considered among the safest assets on the planet, lost over 30% of their value that year. People who had moved their money into bonds in their 50s and 60s, specifically to avoid stock market risk, watched their supposedly safe money drop by a third. This is the part most people never learn until it happens to them. Bonds carry less risk than stocks over the long run, but they are not risk-free, and the specific risk they carry has a name. It's called interest rate risk. The longer until a bond matures, the more its price swings when rates move. A bond maturing in 1 month barely moves at all when rates change. A bond maturing in 30 years can swing wildly, because 30 years is a long time for a fixed 3% payment to look increasingly unattractive if rates climb. So, when someone says bonds are safe, what they actually mean is bonds are generally less volatile than stocks and they pay you back a fixed amount if you hold them to maturity. They do not mean the price can't move violently in the meantime. So, how do you actually use this? Not as trivia for a dinner party, but as something that changes what you do with your own money. If you are in your 20s or 30s with decades until retirement, your bond allocation can reasonably be small, sometimes zero, because you have enough time to ride out stock market volatility and you're not going to need this money for a long time. The classic rule of thumb is something like your age in bonds, so a 30-year-old might hold 20 to 30% bonds, though plenty of younger investors with a long horizon and a strong stomach go even lower. As you get closer to needing the money, bonds become your shock absorber. Someone 5 years from retirement does not want to discover a 2008 style stock crash right when they're about to start withdrawing money. Because selling stocks at the bottom to pay your bills is how a temporary loss becomes a permanent one. A meaningful bond allocation, often 30 to 40% or more as you approach and enter retirement, means you have a pool of money that isn't tied to the stock market's worst week, so you're not forced to sell stocks at exactly the wrong moment. And one more practical piece: if you do want bond exposure, especially in a higher rate environment like right now, consider the maturity length carefully. Short-term bonds are far less sensitive to rate swings than long-term bonds. If you think rates might keep moving and you don't want the volatility, shorter duration bond funds are the calmer option. If you're trying to lock in today's higher rates for a long time, longer duration bonds do that, but you're accepting more price swings along the way as the trade-off. Back to Mark at the dinner party. A few weeks later, Mark actually opens up his target date fund for the first time and looks at what's inside it. He finds out it's holding about 20% bonds, mostly intermediate term, and he finally understands why. It's not filler. It's not the boring part nobody bothered explaining. It's the part of his portfolio that's supposed to behave differently from his stocks specifically, so that when stocks have a terrible year, his entire net worth doesn't have a terrible year right along with them. He still doesn't find bonds thrilling. Nobody is putting bond yields on a poster, but he stops thinking of them as the part of the pie chart you're allowed to ignore. Here's the actual point of everything we just covered. Money has a language, and that language is interest rates, and bonds are how that language gets spoken out loud in a way you can actually watch happen. Every mortgage rate you've ever been quoted, every percentage your savings account pays you, every time the stock market has a strange day that has nothing to do with any company's earnings, all of it traces back to the bond market, doing what the bond market does. You don't need to become a bond trader. You don't need to memorize yield curves or debate the Federal Reserve's next move at parties. But you do need to know what's actually sitting in your own portfolio and why it's there. Because the version of financial literacy that only covers stocks is missing the half of the system that actually sets the price of everything else. Trevor's question wasn't really about bonds, it was about whether Mark understood the thing he'd been confidently talking about for 10 minutes. Now you do. I'll see you in the next one.